Welcome to the 3 Edge Week in Review for the week of February 22nd, 2021. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Today, along with a brief update on the global capital markets, Steve and I will be discussing what could be in store next for the markets, a possible melt up or a possible meltdown. Before we get to this, let's take a quick look at what transpired in the global capital markets this week. Equities really struggled this week in response to a material sell-off in the bond market, which saw the yield on both 10-year and 30-year U.S. Treasuries rise to one-year highs. Both of the benchmark Treasuries have now risen by just about 50 basis points, or 0.5%, in the past 30 days. The increase in long-term interest rates and inflation expectations could be seen as a result of an increase in positive sentiment about the economy in the second half of 2021, with the rollout of coronavirus vaccines continuing to ramp up, and with the likely passage of the Biden administration's $1.9 trillion coronavirus relief package, along with a positive U.S. jobless claims report this week. And while this would undoubtedly be good news on Main Street, especially for folks who have lost their job as a result of the coronavirus pandemic, the good news on Main Street may not be such good news on Wall Street, since investors are concerned about the threat of an increase in inflation, which could put pressure on equity valuations. So now let's move on to our topic for today. After a shaky week in the markets, where could they go from here? So Steve, one thing I do know is we received a tremendously positive response to your recent commentary. Euphoria, market euphoria, how long can it last? And that's still available actually on our website at 3edgeam.com. And so I know from the response that investors are concerned about which way the equity markets might go from here. And as we know, after a tough week, maybe we could discuss both the evidence supporting the potential for either a melt up in the markets or conversely, a potential meltdown from here. So let's start with a potential for a market melt up. What circumstances could cause the market to melt up from here?
Well, as I point out in the paper, Fritz, near the end of a bull market, sometimes you get your strongest gains, and that happens right before the next bear market. And I'm reminded of 1999, an analogy to today, where like then and like now, you could argue the market was highly overvalued. During 1999, we started to get a quite serious chop in the market and then a correction. And it was pretty reasonable to conclude that could be the end. The market was overvalued. It was selling off pretty sharply, and it was time to get out. But after that initial downturn, people bought the dip, the market turned right around, and then it went substantially higher before finally peaking. So we can't completely rule out the idea of a meltdown.
Okay, very good. And so now let's consider what circumstances might come into play that could cause the market to melt down from here.
So, again, in the paper, we outline some warning signs that we are looking at very closely, and we think everyone should. Some people are pretty sanguine, saying that, well, we shouldn't worry about a market meltdown. The Federal Reserve Board just came out this week and said they're not going to be raising rates for a long time, and they reconfirmed that. The economy is actually improving right now, not getting worse. How can you have a meltdown? But now I think back to 1987. It was a period where we had a strong economy. It was not in danger of going into recession, and it didn't. We didn't have a Fed raising interest rates, and yet we had the famous crash of 1987. I remember living through it. And it was very sharp. It was very painful. And it happened without those other conditions. So we look at, well, what are some of the warning signs that could lead to a meltdown right now? So one is actually quite simple. It just starts from profit taking. The market's done so well for so long, and you have the kind of euphoria that we've had. Sometimes people say, well, I should probably just cash in some chips right now and get out while the getting is good and take some profits. And the media reports, well, this is healthy profit taking. This is natural in every market. And that's true. But when we look back in history, we find a number of times when bull markets have ended, And the bear markets just started with what was called at the time healthy profit taking. And you get a serious situation where what starts off as a modest downturn starts to snowball. You get a vicious cycle as more people jump in and take profits. We could also see that if it turns out with all the fiscal stimulus and the stimulus checks and talk about infrastructure spending, if growth and or inflation and or interest rates spike too quickly, that could shock the market into thinking, well, maybe the Federal Reserve Board is not going to have our back anymore. Maybe they will no longer be able to keep printing money, and that could cause a downturn. And then finally, we have a situation where our model shows that the markets have been benefiting very, very well with the narrowing of credit spreads. And that's the difference between junk bond or high quality or low quality bond yields and the highest quality bond yields. And usually you get a pretty nice spread to compensate someone for taking the extra risk of lending to a risky company. Well, this spread has narrowed so much, it's near all-time record low spread. And so if this were to change, our model research says this could cause a big change in the equity market outlook, and it's time to get out. And of course, there's geopolitical instability, and there are just certain exogenous shocks that could come along that are hard to predict.
Absolutely. So I remember the crash of 1987 because I had just moved to London to work, and it really did feel like, oh, this is just going to, go on for a long time, and yet the market recovered really quickly. So.
Sure.
Well, here's another point that I think it's important, and I think that sometimes investors struggle with this idea that, when you're making investment decisions, that it's very binary, that you're either in or you're out, or, you're a buyer or you're a seller. And I think sometimes that can be a counterproductive mindset when investing. So I think maybe one thing we could do to help is discuss the way that we are currently positioned, where we're trying to continue to take advantage of the possibility that the market could move higher, but also understanding that our clients are really counting on us to preserve capital should the declines really turn into a full-blown market correction. So maybe just if you could give, set the scene for us on how we're positioned and why we're positioned like that for the current environment.
Well, the truth is that our model is showing a blend of some positive factors, some negative factors. It's not all one or the other. So rather than being at our maximum aggressive position or maximum defensive position, we're somewhere in between. But we are concerned that valuations continue to get to excessive levels in the U.S. stock market. And sometimes when the U.S. market takes a tumble, at least in the short term, it takes other markets down with it. So we take that seriously. So the way we've been positioning ourselves to be a bit more cautious and respectful of the overvaluation is to rotate away from too big a position in U.S. equities, more toward a position in equities that are not so overvalued, and we find more of those overseas, like in Japan. We've been cautious about the bond market, making sure that we didn't have too much money in bonds that can actually lose principal value when interest rates go up, like we saw this week, and rotate more into real assets, which do better when interest rates on your bonds are so low they don't even keep up with inflation. And then within real assets, we've been migrating somewhat away from just gold and into some commodities, which could benefit from their low valuation. And the idea that with all this fiscal stimulus and talk of infrastructure spending, there could be more demand for commodities going forward. So we're trying to take a view that will help participate somewhat if the market continues to go higher, but is already taking a bit of a step back, should the market continue to struggle. And if our model starts showing more negative signals, we wouldn't hesitate to pull back even more.
Excellent. Great. So that's a really good update. Appreciate that. One of the things that I think about this week is that, it's very nice to have the inherent discipline of having a model available when making investment decisions, particularly in times like this where you're not exactly sure the market's going to go one way or the other. So thanks for that. And that will do it for Steve and me. And we'll be back next week with another edition of our 3Edge Week in Review. Remember, all of our 3Edge videos are available on our YouTube channel, as well as on our website at 3edgeam.com. And if you would like to receive a copy of Steve's latest commentary, Market Euphoria, How Long Can It Last? That's also available on our website, 3edgeam.com, or you can write to us here at WeekInReview at 3edgeam.com. So now on behalf of everyone here at 3Edge, we urge you to remain safe, to stay strong, to keep the faith, and most of all, thanks for listening.